The Fed delivered a hawkish pause. It's widely said, and you point that out, Priya. Misra is with us this morning. You think that that the central bank at this point is actually done hiking, but because of a slowdown that's in the cards that might be, this is a lag effect that we've talked about, your JPMorgan assets, yeah?
So I think the Fed doesn't know. I think they're trying to extrapolate from the recent strength in the consumer spending data that we've seen. I think they're hoping that they get this soft landing. I mean, you look at their forecast for next year, they've got the economy barely landing. I mean, I would say it's a soft landing or it's a no landing scenario. So I think that's what the Fed hopes, which is why I think it was a very hawkish message, actually. So they didn't hike. But what they did was they actually signaled a more positive real rate next year, because if inflation declines as they project, they're telling us that they're not going to cut rates next year. So the market, that's why the rates market reacted. I think it was a hawkish message. I do struggle with this higher for longer, with the fact that the economy is slowing. There are some clear signs of slowdown, which is why we think that this was that July was the last rate hike. But I think the Fed's forecast, that's sort of, I would argue, somewhat fanciful.
I think there may be more of a lag effect, and the damage is going to become more apparent maybe more quickly than the Fed may be anticipating. I think there are serious crunches to the economy, whether that be in lending, being able to borrow, and for consumers at the bottom rungs, being able to pay off your credit card, being able to find housing that's not prohibitively expensive. It's terrible when your groceries are expensive, when your gas is expensive, when it's your mortgage or your rent payment. I mean, that is the biggest chunk of you might be able to keep up with inflation. You complain about it, but you can keep up with some of these things, not when it's the biggest bill that you're paying every month.
Exactly. And I think that just takes a while, because majority of Americans have locked in their mortgage. It just takes a while for people who have to move. Then they have to start, to pay that 7.5% mortgage rate. I would also argue that the COVID savings that we had, I think that cushioned a lot of the blow to consumers. That, in our estimate, in the fourth quarter is likely to run off. I think it's already run off for the lowest rung of households, but I think it's going to come out on aggregate. So I think interest rates just take a while to play out, and the Fed is trying to buy time. But I think, their idea that we can get inflation all the way back to 2% without a slowdown in the economy, without a rise in the unemployment rate. And I would also look at the labor market.
I think they would say they expect a slowdown in the economy and a rise in the unemployment rate. But maybe not as much as is going to happen.
Yeah, I think their forecast for NAIRU or equilibrium unemployment rate is 4%. They're forecasting 4.1. I mean, that's essentially full employment. So I think, our view is that the economy is already starting to slow. You look at the labor market, that deceleration, it's been gradual. But I think as that tends to continue to decline, the 3-month run rate for payrolls running at 150,000, as that gets to 100,000, below 100,000, I think the consumer's ability, where the savings have already run out, their ability to keep spending is going to go down. Plus, you've got all these wild cards, between the strike, the shutdown, higher gas prices. So, but I would say even beyond all these wild cards, real rates take a while to play through the economy. That's our view, why we think the economy is going to slow down, and I think there's value in bonds.
We definitely haven't heard this point of view today, but I would hope, listening to you, would be like, oh, good, we're not going higher because the economy's slowing. But none of this is good that I'm hearing. Either we're going 3 or 4 25 basis point increases higher, and everybody's going to have higher mortgage costs, and it's not what the markets want, another 3 or 4 hikes, but you're telling me they don't need to do it because the economy's already in bad shape or sort of weakening at this point. Those are both bad things, aren't they? We're stuck in a bad situation, a lesser of two evils almost.
Well, I think if inflation declines, I think it's going to come down to that. If inflation declines really fast, I think then we actually get that soft landing. But our view is inflation is going to get really sticky. You get close to 3%, the economy slows down.
That's not in your forecast.
That's not in our forecast.
The economy weakens and inflation stays tough.
And then we all look at the Fed and we say, when are you going to start to cut rates? And I think the Fed is telling us not so fast. They're going to keep rates high enough, or they're going to decline really when they see the whites of the eyes of a recession. That's bad for risk assets, which is why I would say everyone that's hiding out in cash, start to think about reinvestment risk, start to move out the curve, as we say, 10-year rates at 4.5, those are very attractive. Over the long horizon, I think it's highly asymmetric. Those rates can rise 20, 30 more basis points. But I think if we head into a recession and the Fed stands back, I think those rates have a lot of room to decline.